Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we're talking about how women can get smarter with their money, and it all starts by taking more interest and then taking ownership and charge. Well, now we are going to talk about 3 stages very, very quickly: creating that safety net, then coming to the investing journey, and then talking about longer-term goals like retirement and give you a sense of how you can go about it. So, Suranjana, let's take step number 1, which is having a safety corpus in place. How do you do the math? And then do you leave this money in the bank, or should you go the mutual fund way, look at maybe some debt funds, but ensure that, you get the money when you need it?
Yeah. I think very important, like I mentioned earlier, that to start early, because a lot of times the trigger is to start when an incident happens. And that is something that we need to really think about. We also need to think about that, when we look at the corpus, we have to have a growth mindset. You cannot have money lying in your savings account, and because that is not going to earn you enough money to be able to build a corpus. It's also important that you actually build a resilience, like building a corpus which actually takes care of your insurance or takes care of your emergency requirements. That is extremely, extremely important and a complete non-negotiable. It's also important that you review this, whatever you are planning. It's important to have a check in place, and periodic checks will also tell you if you've made certain mistakes and you need to correct them over a period. I think mutual fund becomes a great tool to actually look at. See, essentially mutual fund's purpose is to get everybody's money together and give it to an expert. The fund manager is the expert who's, managing it on your behalf. So you don't need to be the expert there. The other thing is that, in India, mutual funds are a very egalitarian solution. It does not differentiate between a large investor and a small investor. So that is something which is very important from a point of view that anybody can start investing. You don't need enough corpus to start. You can start with very small amounts, and then you can also sort of diversify your risk, because there are so many vehicles which are available to invest within mutual funds.
Absolutely. So plenty of options there, and you can start with the funds that are right for you and get the right advice on it as well. Actually, speaking of starting the investing journey, we have a query coming in from another viewer. Shilpa wrote in to us, and she's saying that, and actually it was a pretty lengthy query. For the sake of keeping it short, we've sort of made it a little brief. She's saying that she's actually a homemaker and she's been investing on her family's behalf for 20 years, and a fair amount of money is in mutual funds. But she says over the last couple of years, she also did a lot of direct stock investing, and now those stocks are sitting on substantial losses. So she's saying, what is a better option? Should I just go back to mutual funds? And how do I look at the whole investment process? Mrin, let me come to you with this question and with a broader question as well on, using the right investment approach, both to have a safety net and then to start really creating that big corpus. How to go about it?
With respect to Shilpa's query, what I would like to say is that, it's easy to buy stocks when the markets are going up, and it's difficult to own stocks when the market are down. And I think it's a good time for you to really evaluate these stocks as to why you bought them, what did you see in these stocks, and you really, if you can hold them further or not. You probably would need help of an advisor to do this as well. But, in my opinion, Surabhi, I always believe that mutual funds are always a better vehicle, because as they say, that leave the stock picking to the experts. As individuals, it's very difficult for us to figure out what segment is going to do well and where the markets are headed, and all the information that's available is really not enough to take the right stock decision. So I would always say that mutual funds are a much better option. And again, a lot of people get daunted, like when you work on these goal planning calculators, you get very daunted by the amounts that come up in these calculators, right? So what I would say that, again, a good way to really look at increasing your wealth, and again, given the fact that the IWD theme this year is accelerating action, I would say, keeping in mind the accelerating wealth action aspect, I would say a great tool that actually exists today is the step up SIP. Right. And if you're finding it really difficult, like you worked on a goal planning tool and it tells you that you need to invest this X amount, and you feel, oh my God, how do I actually do this? The step up SIP is much easier. So I'll give an example. Let's say if somebody does a SIP of 50,000 rupees for 10 years, and we are assuming a 12% return. So in a normal SIP, you can expect a value of, let's say, 1.16 crores. But if you say that, I'm going to invest this amount and I'm going to do a step up of 10% every year, wherein I'm going to increase this amount by 10% every year, you're ending up with a much larger corpus of about 1.7 crores, So what I'm trying to say is that, again, move this focus away from saying that I want to get this 15-20% return, right? Focus on two things. One, do you actually have the ability to manage that investment? And
Sure.
two, on the corpus. I think that really needs to be the focus area, for which step-up SIP is a great option.
Mrin, I want to take a step back. That step-up SIP example is great because, I mean, the accumulation just really improves, right? The moment you decide to commit more, a little more every year. But I want to take a step back. Your assumption was 50,000 crores going into a SIP every month. Let's take a step back in terms of how much we really need to save. Now we're talking about an average woman who's probably looking at retirement and, probably has goals maybe a decade or two down the line. So now what is the math? Tell us the math, because I saw those numbers that you put out. They look a little scary in terms of how much we need to start saving and investing.
Yeah, so, actually, on an average, Surabhi, I'll say people need at least 6 to 8 crores of corpus. But let's say you're 30 years old today and you've got expenses of 1 lakh rupees per month, which is easily doable in a city like Bombay, right? And you want to retire at 50. So let's also remember that as far as retirement is concerned, the age at which people want to retire is actually coming down, right? So you want to retire at 50, you will actually need a corpus of 11.5 crores, and you need to invest 1.5 lakhs every month to actually reach this particular goal. If you assume an 8% return, so I'm assuming, let's say you're just doing the EPF, for example, right, which is the Employee Provident Fund, right? But, if you can add some equity to this now, then the investment amount is going to come down to 1.32 lakhs, right, per month, I'm saying, okay? So hence, what I would like to say is that whatever stage of life you are, it's important to start saving, especially if you can start saving early. Then, you have time to basically build your assets, and you need to have a good amount of equity allocation if you want to beat inflation, because remember, the value of our goals is also very high at this point in time.
Absolutely. Those are some sobering numbers there, numbers to definitely think about. Well, it's helpful. At least it puts us on that thinking track. So, Suranjana, I mean, coming to sort of final thoughts and summing it all up, let's say if you were to give the 3 most important tips for women, just, quick checklist, what should they keep in mind when they're planning their finances?
I think most important is to start. The start does not happen, and I think that is where people need to push themselves. There is no requirement of thinking of everything else, all the variables. It is just about taking the plunge. That is the most important. Emergency corpus, like we mentioned, is something which a lot of people don't pay attention to, and that is something, again, which is very, very important. And it's also very important to keep putting a check of what you are doing, rather than just, putting some investment and then just completely forgetting about it. While that can have a different result because you are not paying too much attention to the market volatility. But the fact is that you need to have a clarity in terms of, what you are going towards, rather than just, adding to your investments without a thought in mind. The why is very important, I feel, in investing.
All right. The why is important and starting is important. So at least make a beginning somewhere. Ladies, thank you very much, Mrin, as well as Suranjana. It's been a pleasure having you on the show. And thank you for getting these conversations going. Well, with that, we are out of time. We have to take your leave. It's a wrap on this special edition of Let's Talk Money. Remember, keep sending us your queries, your comments, and any other thoughts that you have. We'll see you again with another theme next week.
Let's Talk Money